All right, hello, everyone. Happy Monday. Welcome to your weekly market check-in here with myself, Greta Wall, your host, and I'm joined by Derrick Oldensmith, the leader of T3 Live's ProDesk virtual trading floor and professional prop trader with T3 Trading Group. Derrick's our first of the new year, so happy New Year to you and happy New Year to everyone with us. How's your Monday and your week going so far today, Derrick?
Happy New Year. Glad to be back in 2025 with you. Things are good. I mean, the market's moving. So the market's moving. It's keeping things exciting. We've had a pretty big dip come into the market between Friday and the gap down this morning. These quantum stocks are still in play. It's been a huge focus for me for some weeks. Actually flipped long a little bit on them for a cute little day trade, maybe 1 to 2 day swing trade. We'll see how they close today. I don't think that we were able to speak too much together the last couple of weeks, but these quantum computing stocks on the short side were a really, really big focus of mine for a couple of weeks there. That trade fully worked out, and now it's at the point here where I'm actually putting on a little bit of a trade on the long side for a couple of these names. So we'll see.
All right. Quickly, let's take a look at Derrick's current positions. This is the positions that he's in as of our discussion here today. Again, he is a professional prop trader with T3 Trading Group. So just a disclosure there on what he is currently trading. You can see some of those quantum names there on the long side in his positions disclosure there. All right, Derrick, our topic of the day, tech tumbling. The market pulling back, the NASDAQ down 1%. So we've got a little bit of a bounce back from earlier in the day. But of course, we saw a big pullback on Friday after that jobs report came out, that hotter than expected jobs report. What do you think of the market environment today with tech down to start the week?
Sure. So I think that what I saw this morning, and I think it included the gap down this morning where we were trading at that time, is that the S&P is off 5% from highs and the NASDAQ is off 7.5% from highs. So the NASDAQ's not even in full correction territory, but the market has officially broken into a downtrend on its daily charts in at least the small and intermediate timeframes. So I would still argue that the big picture is bullish. So we've got a little bit of a competing message from the market where our small and medium timeframe trends are lower, but the big timeframe trend is higher. So this market is guilty until it proves itself innocent at this point. A lot of this is stemming from interest rates and the move in the dollar, which, if you remember, when we were speaking back in November, that was something that I was becoming really concerned about in mid-November, is that interest rates were really moving higher. And then we had a little bit of a relief bounce in bonds. So interest rates came down a little bit in the back half of November and beginning of December. But from that pivot high in like the TLT chart, just a simple way to look at it, we have really deteriorated down, and it's becoming a big problem for this market as the dollar moves higher. And I think at a certain point, a continuation higher on the dollar becomes a problem also, because when you think about a lot of the biggest companies that are in the S&P and the NASDAQ, they're multinational companies that get, I think, 40-something% of their revenue abroad. So I remember in that 2022 period when the dollar was really strong, we were seeing like Microsoft and a lot of the big Mag 7 names missing on earnings reports because they were warning about FX concerns negatively impacting their ability to do business abroad and negatively impacting their earnings. So it's an interesting environment right now. Everything else held equal, would rather be short than long, but everything is never held equal. And when I'm looking at market technicals, I need to think about them in terms of where we are, in not just with the trend, but how extended we are. And on a morning like this morning, even though the market's become a bit more bearish, we were so extended down with the gap down this morning that it was worth it to put on a few longs. And as a team, my ProDesk virtual trading floor that I work with, we were buying Apple, Qs, semiconductors, and we were able to make a few bucks doing that as well. So it's been a great environment.
When we came, the last Fed meeting in December, the consensus was we'd get a couple of rate cuts in 2025, less than previously expected, but we were still going to get some rate cuts. And then a real hot jobs report came out last Friday, and everyone's like, maybe we just, maybe we'll get one cut, maybe we'll get no cuts in 2025. This week is the CPI. We get the CPI. I think the PPI is tomorrow. The CPI is Wednesday. It's flipped this week than normal. But CPI Wednesday. we had got to a point where inflation numbers really didn't kind of matter. The Fed had already declared victory on inflation. And then at the last Fed meeting, you know, the chairman said, we might have some more work to do on inflation. And then we get that hot jobs report. How much does this CPI matter a lot more now than it would have maybe 3 months ago before all the numbers that we've seen recently?
Yeah, it's starting to matter more again. People are on the edge of their seats on what's going to happen. I don't think that we really want to see inflation tick back above 3%. Like you said, we at one point were pricing in, I think, 7 rate cuts in 2025. Now, as of this morning, I saw that we're pricing in just less than 1. That's a huge, huge move. It's starting to get to the point, though, where I'm wondering if the market is overly pricing in no cuts at this point. We've seen it so consistently over the course of this entire Fed cycle now over the course of the last 2 years. It's been very common that the market will very consistently overshoot and undershoot what the Fed actually does in terms of we're pricing in 1 million cuts and then just a couple happen, or we're pricing in no cuts and then just a couple happen. So I'm actually starting to wonder if they're starting to get to the point where they're overpricing this into the bond market, which eventually at some point could give a bounce back, which could help equities as well. But I need the market technicals to prove themselves. We got to start by getting the SPYs back above 580. We got to start by getting the Qs back above 510. And then the market technicals can begin to heal a bit again, and I can feel more confident on having long positions on.
How much does the change in the Fed picture change the market expectations for yourself for 2025 and what we might see happen?
2025 is a big year. It's only January 13th. So
Yeah.
I am not in the business of making huge projections on where we're going to be at the end of the year. My thought process tends to not really go out for much more than just at the most a couple months, just because the evidence and the data are so constantly and consistently changing, and I'm an evidence-based trader. I want to read the research. I want to see what the technicals look like and make adjustments from that. And even if I have a thought process or a thesis that might extend out a couple months, that's something that is constantly evolving on a day-to-day basis oftentimes. I mean, I was very bullish for all of December. Like if you go back to the beginning of December or end of November, my thought process was to be bullish for all of November and the first half of all of December and the first half of January. And then when the Fed came on December 18th, the evidence changed, the technicals changed, everything changed. So then I adjusted my thought process of, wow, I can't be as bullish as I was because the market just broke here technically, and it needs to be able to prove itself and reset up before it can become a bull again.
We got a question from YouTube. Cyril asked, what signals are you looking for the reversal? Some kind of a catalyst?
I'm not sure if he's referring to a reversal in the equity market or a reversal in interest rates.
He put in this question when you were answering my question about the CPI battering and all of that, what it comes to.
So the first thing I would say is I try to never predict reversals as a rule. I try to predict places that are reasonable for a retracement. And there's a lot of different technical ways in which you can try to do that. So for example, one of the big things I like to measure is just market extension, because market extension shows me whether or not the market on the small time frame maybe gets ahead of itself or not. So this morning we were starting to get into what I consider to be the extreme extension zone. We're just starting to get into it, and it's the beginning of the week. So I was willing to put a couple longs on this morning as day trades, and they worked out. But what I would really love in order to size up would actually be a weak close today, followed by a gap down tomorrow. Then we would have like a bigger day 3 with an even larger amount of extension into a gap down. That would be an area where I would load the boat probably a little bit more to look for an upside retracement off of that extension. And then I have rules in place that can enable me to hold a retracement for at least a percentage of my position should it actually become a reversal. So that's what I'm looking for. As far as like the market evidence that I was talking about earlier, paying attention to the macro to try to predict when like interest rates are going to top out and bonds are going to bottom. Very, very, very difficult to do, especially when it comes to, I think, the bond market. I find that the technicals in the bond market are a little bit trickier to read than just the equity market, because you've got governments that are involved, and the governments are just such massive players when it comes to bonds and interest rates compared to the equity market, where obviously there's big players as well. But I find that the technicals tend to be a little bit cleaner there. So we'll see. That's what I'm looking for right now when it comes to the market, though, is if I can get a little bit more downside extension. If I can get like a big day 3 gap down, I probably would get pretty heavy to the long side at that point, looking for a retracement, and then see if the retracement actually becomes a reversal.
All right, this next comment, good transition to my next topic I wanted to talk with you about. From YouTube. So this happens every quarter. The pre-earnings discount. Bank earnings will kick off a rally. Q4 earnings season does begin this week with the banks. It's weird. Chase not reporting on a Friday. I think they're reporting on Wednesday this week. It's very weird. I was looking at the schedule. I was like, oh my gosh, Chase not on a Friday. What are we going to do? So JP Morgan kind of kicks things off with some other big banks. Then we'll get the series of banks into next week. I think Tesla and Netflix being the first big tech earnings that we'll get next week. But with the start of Q4 earnings season this week, what is your focus for this earnings season and some expectations on a broader aspect as we look into the beginning? And then you and I will, of course, talk about earnings as it goes on over the next few weeks.
So the big thing, I think, is that the Mag 7 has become the entire stock market in so many ways that do the banks matter? Of course the banks matter. And generally I've been a bull on the banks for a little while now. But that's not what's going to move the S&P, and that's not what's going to move the NASDAQ really throughout this earnings season. It's going to be Mag 7 just because they're just such a high percentage of the S&P and the NASDAQ at this point. And then when it comes to the Mag 7, the question is the same question that it's been the last several quarters, which is, does the spending on AI justify the revenue that actually comes in from it? We're pretty far away from the Mag 7 earnings. I think that they'll probably be, I'm not even 100% sure, but I'm guessing like the very beginning of February, very end of January. But we will get at least a little bit of a taste when it comes to the banks. And I have generally been bullish on the banks, but it's interesting to see, or it will be interesting to see when it comes to the conference calls, the impact of this recent move on interest rates on their business.
All right. Let's talk about some recent trading for you. Let's talk about the quantum stocks. You mentioned in the beginning you were short these quantum names in the past few weeks, and then today you flipped long. Pick one of them and kind of walk me through. We can look at the chart, walk me through, what you did on the short side, and then, what got you long today.
Sure. I'm just getting an order in the market real quick.
Do
you want to go to the screen share?
Yeah.
Okay. Cool.
And remember, guys, Derrick is a real trader. I mean, he's trading the whole time we're talking here.
So I these quantum names have been such a big focus for me. I've traded just so many of them. I was probably most active in RGTI. I was very heavily short RGTI. I had QUBT short at one point, but that was more in mid-December. But in this recent down move, I had RGTI, I had IonQ, I had QBTS, I had LAES, I had KULR. I had all these to the short side in these climactic parabolic moves that came in. And honestly, it was a phenomenal combination of a great end of the year and early start of the year for me from a P&L perspective. Obviously, this gap down, if you look at RGTI, which again, I think is the one that I was most active in, so we can primarily focus on that. If you look at this gap down that came in when Jensen Huang, the CEO of NVIDIA, came out and he said that he thinks quantum is really interesting and is a business of the future, but it's still 20 or 30 years away. That just absolutely destroyed these things. And at the same time, though, you always have to be a little bit careful with fundamentals, because the fundamentals, in my opinion, are not good on RGTI, doesn't mean that it can't move higher when it's going parabolic like this. I remember just doing some fundamental research on RGTI and seeing that in the first 3 quarters of 2024, they brought in $8 million of revenue, but had at a certain point somewhere near highs, like a $5.6 billion valuation. I mean, the numbers just didn't make any sense.
Yeah.
With that said, you have to be careful about taking a fundamental thesis and just blindly shorting the market, because you could have said the same thing when RGTI was at 9, and it just continued higher. I think there was a big gamma squeeze that was going on because there's a lot of option flow that was coming in on the long side, a lot of big calls that were coming in, and all these names were just squeezing higher. I was actually asking myself the other day, actually I think it was this morning, when I was coming in and buying Apple and TQQQ and SOXL into the gap downs this morning as day trades. I've always considered myself to be really more of like a with trend trader. And I still would argue that trading with the trend is the easier money in the market than trying to pick tops and bottoms. Picking tops and bottoms is generally a fool's game. It's very, very difficult. But then with that said, I spend so much time measuring extension and then coming in on the other side and taking counter trend trades in periods of extreme extension that I was almost asking myself this morning. I was like, what type of trader even am I anymore? I always was a with trend trader, but I was looking back, and I guess part of this is in my head because I just did like an end of the year review for my 2024 trading, and I was going through my P&L on where I did well and where I did poorly throughout the year. And some of the biggest money that I made in all of 2024 was counter trend on extreme extension. I had a lot of P&L in 2024 that was just index related, where when the market hits those extreme extension points, like I was just talking about a little bit earlier, we basically got to that with the gap down this morning. I came in long, made some money in the Qs. Like that trade has been a very consistent trade for me. And it made it so that the TQQQ is one of my best names of the year. But then I remember, I did really well with this Tesla short when this reached its peak in December. That's a counter trend trade, obviously. Did extremely well. So one of my trades of the year with MSTR on the gap up to 550 pre-market that day, and the short that came in off that extreme extension. And then the quantum short, if you combine my P&L and all of the names I traded at once, turned out to be one of the best trades I've ever had in my entire career after this gap down. And it also is a counter trend trade. So I'm like, oh my God, what type of trader am I becoming here? I still think that this is the more difficult money to do this. Because especially with RGTI, I started a little bit too early, a little bit too heavy, and I was down a good hunk of change in this one at a certain point. There was a couple others I was never really down much in at all, but this one I was down a bit before it finally worked. And now the fact that I'm long these today is the same trade but the opposite, except I'm a little bit more nervous when I don't think that the fundamentals justify my technical trade. So like when it came to RGTI on the short side, you had this topping tail that came in. That was a signal on this push through failure through $20 that you could have been short versus. But in the back of my head, even though I'm a technical trader and I'm going after the technicals, it definitely helped give me conviction knowing that I was shorting a stock that was not a low float stock, by the way. That's really important. If you're going counter trend in low float stocks, especially on the short side when momentum's coming in, it's a way to get entirely massively blown up. But this is not a low float stock. And I was given confidence, like I said, knowing that they had only produced $8 million in revenue in 2024 while having a $5.6 billion market cap. It just made no sense. Now I'm going long RGTI right now. I'm long RGTI, I'm long QUBT, I'm long SOUN. I'm just long those three names. SOUN's not quantum, it's AI, similar but different. But I actually don't believe in these stocks even at these prices. And that's the difference. Like RGTI, when I was shorting it at $20, was like, all right, I genuinely think that this stock belongs at 4. I'm only looking for a move to 8, but I think that this stock belongs at 4. It helps give me a lot of confidence. Now I'm going long this stock at $6, $7 today in RGTI, recognizing that the ADMA is up at $12.50. It's a day 3 to the downside with a massive amount of downside extension on the daily chart. So all I'm looking for here is a little bounce back, little retracement trade to the upside. But I'm not going to do as well, and I just know myself at this point. I'm not going to do as well on this trade as I was able to on the short because I don't have the same degree of conviction. I still think the stock belongs at like $3 or $4. Yet I'm buying it at 6 or 7 today, but I'm buying it specifically because of the technical downside extension. I think if I can get a little bit of a bounce back on this, I can make a few bucks for myself. And even if a stock, let's say, belongs at $3, whatever that means, and I'm right and it works its way down there, it doesn't mean that it can't have bounce backs along the way. As a matter of fact, that's typically how stocks work and how markets work. They will have bounce backs along the way. If it's going to get down to $3, it probably will at some point, hopefully today because I'm buying it, but can't be sure. I would expect at some point it gives a little bit of a bounce back, a lower high, and then actually works its way down to where it belongs. Again, whatever that means. So that's been the trade.
All right. This market giving Derrick a little bit of a existential crisis about who he is as a trader. A question we got from YouTube from Javier. He wants to know, Derrick, how do you decide to enter a position pre-market versus waiting for the open?
Sure. How do I decide if I get into a stock pre-market? So I do my research starting very early in the morning. We start getting research into the team virtual trading floor called the Pro Desk at probably 7:30, but I really start my research process well before that. So if I'm doing my research process and I see a trade that I'm interested in, I then have an option of get in some now, or write it down and wait for the market to open and consider getting involved after the market opens if it's still trading around that price. So what do I do? Do I decide to just take it now, or do I decide to wait for the market opens? It depends is the answer. It depends on a number of factors. One of the biggest factors it depends on is liquidity. You can be wrong, and you can be wrong at any time of the day. So for example, like I bought some NVIDIA pre-market this morning at, I don't know, maybe 132 or so. It was a very small feeler position. And then bad news came out and NVIDIA cratered down like $3 or so from where I bought it. Luckily, it was just a real small feeler position. So I was able to trade around it. And eventually I was able to make money on the NVIDIA long as a day trade. But one factor that you got to keep in mind is liquidity pre-market. NVIDIA tends to be a fairly liquid stock. I can get into NVIDIA and out of NVIDIA if I'm trading it at 8 o'clock in the morning without any problem, or even if I'm trading it at 5 o'clock in the morning without any problem. Other stocks you're going to find have zero liquidity pre-market, massively wide spreads, and you almost can't trade them pre-market even if you wanted to. A lot of the times what I'll end up doing at this point is if there's a stock that I'm interested in and it's liquid enough, I'll start by just taking a pre-market feeler. I have a small enough position for me where if all of a sudden something happens pre-market and my idea is proving me wrong before the market even opens, my position is small. It's not going to hurt me. I can manage the position. I can liquidate the position because I'm not too heavy, even if the pre-market liquidity is low. And then if the trade is still showing me that I'm right as the market opens, I can then utilize that as a time to be able to get heavier as necessary if the trade calls for it. So that's a lot of what I'm thinking about when I'm doing it. I generally speaking, if I have an idea and I want to be in it, then I'm just gonna be involved, and I really don't care what time of the day it is. But there is a whole host of extra risks in doing things pre-market that newer traders especially need to be very cognizant of. I do not recommend for people who are in their first year of trading to do very much, if any, trading pre and post market, because certain routes don't work. Your stop orders probably don't work. Market orders don't work because the market's not open, and you need to be aware of how that plays out pre-market. If you're going to get in trouble, you can't just have a pre-market buy, put in a sell stop, and walk away and expect that sell stop to trigger. And you might not even want that sell stop to trigger, even if you could, because there's going to be no liquidity for it. So it's just a little bit of a different ball game, and you got to just understand the liquidity, and that's a big part of it.
All right. I know you don't give big, wide predictions for 2025, but we've got 3 trading weeks left in January. This week, next week, week after. Lots of important things coming out in those 3 weeks. We've got the CPI this week. Q4 earnings season is starting this week with some big names, bigger tech names next week, and then the Fed meeting to wrap up the end of January. What's your thesis as we head into the next 3 weeks of January in trading?
Sure. So I'm continuing to watch the market extension. When we get through OPEX this week, it'll be interesting because it potentially has a little bit of a loosening effect on this market. And I was arguing that given where interest rates are, the equity market should be, air quotes, should be lower than where it's actually been, even with Friday's breakdown and yesterday's gap down. But the reason why we haven't been able to get any downside follow through is because where we are from a market dynamic perspective, pre-January OPEX is a little bit more insulating. And the amazing part about this early January weakness that we've seen is that has happened with a ton of money inflow into the market that's forced inflow in the first 2 weeks of January. That's some of where this January effect concept comes in, but it's forced buy flow that comes into the market after a really strong year like we just had in 2024. Yet even with all that forced buying flow that insulated the market, even us with us being pre-OPEX, which has insulated the market, we've still managed to sell it down. So I would argue that if interest rates sold to, if bonds sold down to where they were, if interest rates moved up to where they were, if this move that we're seeing in the TLT was happening like next week instead of last week, the market would have gotten smoked significantly more. So, but that's not necessarily a prediction that when we get through OPEX that the market's going to go down, because this actually has an impact both ways. If the TLT now, when we get through OPEX, can stabilize or bounce a little bit, then it actually could lead to an even bigger bounce back for the equity market than would have happened otherwise. So it's interesting. I'm not 100% sure, I would say, is the direct answer. I'm kind of playing this a little bit day by day right now with where bonds are moving and the equity technicals. But watch to see if this TLT can stabilize and bounce. If that happens and, so this is an if-then statement, which is how I love to approach markets. If that happens and the SPYs are able to recapture the 580 level and the Qs are able to recapture the 510 level and the IWM is able to capture the 218 level, then we actually could have a decent bounce back on the second half of January through the first half of February. So that is the if-then statement that I would be keeping in the back of my head if you're trading this market right now.
All right, good stuff. All right, for everyone who is with us live, if you want to get Derrick's free ebook, you can go to t3live.com/DO live. Again, t3live.com/DO live. It's an ebook about the benefits of prop trading. Again, Derrick is a prop trader with T3 Trading Group and the leader of T3 Live's ProDesk virtual trading floor. Derrick, have a great rest of your week trading. And next Monday is a holiday. So see you in 2 weeks.
Thanks, Greta.
Enjoy.
Talk to you soon.
Have a good day. Bye.